Welcome to today's webinar, Delivering Data and Custody Governance in Testing Times. This is part of the PLSA's Education Partnership with CACEIS. What we're discussing here today is a topic that can be critical to the health of your fund, but may be overlooked. Data and custody governance, essentially where and how your fund's assets are actually held, is a key piece of good fund governance. Add to this the topic of cost transparency, understanding your total cost of investment, and you have the recipe for a strong governance framework. My name is Rachel Pine, and I look after content for the PLSA's conference and training offerings. Today, we are joined by Pat Sharman, Managing Director of CACEIS, and Scott Foster, a cost transparency specialist there. Scott is also a technical expert panel member of the Cost Transparency Initiative. Pat is going to tell us about data and custody governance, and Scott is going to tell us about costs, and then they're going to explain how they link together for good governance. The CACEIS UK pensions team was previously known as CASBank, you may know them that way, which accumulated specialist knowledge across pensions markets such as Holland and the UK. Last year, CASBank was integrated into CACEIS, a securities and administration specialist backed by Crédit Agricole and Santander. That's everything I need to say to start us off. So welcome, Pat.
Thank you, Rachel, and good morning, everybody. Thank you very much for joining our webinar. And as Rachel's alluded to, I am going to cover off the role of the custodian bank and how they can help pension funds with governance. So I've been in custody for over 35 years. I joined Midland Bank, the listening bank, so if there's any of you that are as old as me, you will remember them, in 1985. So first of all, what I'm going to do is I'm going to cover off custody at a high level. So what your global custodian does for pension schemes, so key services that pension schemes take. So we'll just move on to the first slide. So first of all, I'd like to say that custodians are one of the service providers that are generally forgotten about until something goes wrong. So one of the key services, and I would say the #1 service, is the safekeeping of the global listed assets of the pension scheme. So you would say, well, why is this so important? I would say, firstly, you want to have your assets held with a strong financial institution away from the asset managers. And a really good example, albeit another old one for the older people in the audience, will remember Robert Maxwell. So Robert Maxwell, between 1985 and 1991, stole the assets of the Mirror Group pension scheme. He stole the assets. So many thousands of employees lost their pension funds. So #1, safekeeping. So we also provide administration on the assets. So we settle trades, we manage corporate actions, so mergers, takeovers, rights issues, we collect dividends and income, we reclaim tax, and we actually undertake the proxy voting on behalf of the scheme. Another bunch of services are treasury services, so cash management, which I will touch on a little bit later as to why that might be important, things like securities lending and FX. So those are services that you can take from your global custodian. But one of the most valuable and underutilized services that I think the global custodian provides to pension schemes is governance reporting. And this is independent. So that's a really important word for this webinar. Independent valuations, independent performance measurement and risk analysis, cost transparency, ESG are just an example of some of the services that we provide. I'm now going to cover off just some questions that I think the answers are, or these things are just not generally known about global custodians. So safekeeping, are the assets held in segregated or omnibus accounts? Well, first of all, I will state that all assets are ring-fenced away from the global custodian's own assets. So that's #1. However, assets are often held in omnibus accounts. And one of the reasons this is actually the way in which they're structured is because it's cost effective for the custodian and it's an efficient way of holding assets. However, that means you as a pension scheme have your assets pooled in an account with other clients of the global custodian. So that could be hedge funds, sovereign wealth funds, insurance companies, etc. And again, you might say to me, well, why does that matter, Pat? Well, if your global custodian or one of its sub-custodians should fail, you are reliant on the records of the global custodian. You are reliant on those records because the liquidator only has one way of identifying your records or your assets as a pension scheme. Now, hopefully those records are accurate. However, it could take many months or many years for the liquidator to identify your assets, especially if you've got a very large bank that's just failed. You may find that some of its clients have also got into trouble and they have their assets pooled with yours. So sub-custodians, who are they? So a global custodian, I often actually try and use them as an analogy as a supermarket. They are one organisation that you can go to have access to multiple global markets. So a global custodian will appoint a local financial institution, usually a bank, in all of the markets that their client invests. And they have to be local because they have to have connection to the local infrastructure and understand the local regulations. So your global custodian is actually responsible for the appointment, the management and the monitoring of those sub-custodians. I often ask pension schemes, do you know who those sub-custodians are, even if you know who your global custodian is? Cash. So another really important area, and I don't think many people understand that the cash is actually held on the balance sheet of the custodian bank. And they will hold that cash as banker. And what that means is that cash is not segregated, so not segregated away from the global custodian's own assets. So again, you're very reliant on the books and the records of the global custodian. If they are correct, you're probably, and they should be correct, you'll be fine. However, in accordance to all the different local market rules and regulations, there should be some sort of deposit protection scheme in place. However, there is a chance that you may not get all your cash back should that global custodian or a sub-custodian fail. There is ways in which to mitigate that risk, and I touched on it very earlier with cash management. You can actually ask your global custodian to manage your cash so that it's actually swept off of the balance sheet of the global custodian and maybe shared amongst other banks through deposits or invested into an overnight liquidity fund. So there is ways in which to mitigate this risk. So pooled funds, again, if they are a fund with listed assets, so equities, bonds, they will often also appoint their own global custodian. So you might have a custodian for your listed assets that you invest direct for your segregated mandates, but the pooled funds that you invest also have a global custodian. So I think it's important to know who they are. Should someone fail in the market, it's important that you know where your assets are. Now you can ask your global custodian to register these assets into, or the units of the pooled fund into your name. This does create a double cost, although the cost is usually minimal, and it just provides more oversight and more security on those assets. For governance reporting, again, I don't think everybody realises that custodians will provide reporting on all investments and all assets held by the pension scheme. So those assets outside of custody. So for example, pooled funds, it might be property, it might be derivatives. We can actually provide independent, again, I come back to that word, independent reporting on all of those assets. We also would reconcile to the records of the administrator of the funds or the asset manager on a regular basis. So you get that double security. So I'm actually going to now provide you with a brief overview of a handful of the governance solutions that you can take from your global custodian. So again, we talk about independent oversight, and I'm only just giving you a very small example here, but ones that I think are of interest. So again, you know, performance attribution and risk analysis. Absolutely key that a pension scheme has and understands the impact of the decisions made by the trustees, their investment consultants, their asset managers, and obviously the impact of any changes within market. And I think this becomes more important in times of market stress for you to actually understand performance and risk within your portfolios. Now, what the custodian brings you is independent oversight of that. So you're not reliant on the asset managers telling you how well they've performed or if there's any risk in the portfolio. Independent, and it's consistent. So the methodology across all mandates is the same. So you can compare like for like, and then they can consolidate that. So as a pension scheme, you can have that independence, you can have that consistency across all mandates, and that consolidated oversight on how your scheme is performing and any risk. So ESG, one of those topics that's getting hotter every day. You can make a joke to that on climate change, but I won't, but it's a hot topic. And many of you would have seen that USS have just announced that they're now going to exclude tobacco, coal and weapons. So it's going to go further up the agenda. And what your global custodian can do is actually help you as trustees and pension schemes demonstrate that your ESG policies have been implemented. This will provide you with that independence again that you need to confirm that. And we're all going to have to report that as trustees. So again, it's really key. So we can actually report, has your asset manager complied with an international standard or principle? We can screen for exclusions. So for example, the example of USS, we can screen that tobacco hasn't been invested in, for example, and we can provide ESG ratings across all portfolios. And again, that consistency, that consistent methodology across all asset managers gives you that oversight. And then of course, cost transparency. I mean, Scott's going to provide you with a very interesting update on cost transparency, some really interesting insights, but I think it's just a key governance service that we can provide you, providing you with total cost of ownership and help you assess value for money. So I think what I'm trying to demonstrate here is that we as custodians can provide you with some really great governance services and help you improve governance. And I would actually ask, are you making the most of those services that can be delivered from your global custodian? So I just want to touch on the future of good governance and how I think we could raise the standards in the UK. So a lot of pension schemes who do take these governance services from their global custodians, they take them on a monthly basis. And I'm going to generalize here because there are a lot of pension schemes that do otherwise, but generally they will take monthly reporting. However, what we do see that in some markets where they're seen as being the sort of well-governed markets, so for example, I'll use the Netherlands, they actually have daily oversight of their assets. So they have daily valuations and they actually they monitor their assets on a daily basis. So they would have a daily alert that someone has breached a policy or there's a risk that suddenly come into the portfolio that they didn't expect. So for example, someone's invested in tobacco, my policy is that I want that excluded, they will be alerted on that same day, whereas a UK pension scheme taking monthly reporting might not be aware of that breach for a month. So I think that's something we should really think about in the UK. And then I'm going to touch on look-through. So again, in the Netherlands, look-through into pooled funds. So this is look through into the underlying assets is a regulatory obligation. Dutch pension funds have to actually look through to those pooled funds. And again, why is that key? Well, I think it's the only way that you can actually understand the risks and you can actually understand them on a regular basis. And I'll give a couple of examples to the right-hand side where I think had those schemes had looked through into their pooled funds, they would have better understood those risks. So this is something we're going to cover off in the future. So probably for our next teaching or webinar with the PLSA, I'm going to do a deeper dive into these areas. So just to round off on custody, and thank you very much for listening to me. I think I was quite brave actually doing a presentation on custody. It's not always the most exciting subject. So thank you for listening, but I just want to touch the benefits. Well, for me, there's two. the asset safety and the risk mitigation has got to be number one. And I think number two is that ability to be able to provide you with independent governance reporting. I think that is a very underutilized service that pension schemes should take. Anyway, thank you very much. I'm now going to hand over to Rachel, and Rachel's going to wake you all up with some polling questions, and then Scott's going to provide you with some very interesting new insights into cost transparency. Thank you.
All right, thank you, Pat. I don't think that was boring at all. That was actually really great information that I've certainly hadn't heard before.
Thank you.
So as promised, we have some polls that are going to take a temperature a bit about how you're feeling. So for the first question, what are you worried most about? Risk of a low return environment, more volatile financial markets, increasing regulatory burden, my asset manager's cost disclosures are not sufficient. All right, I'm going to end the poll there. And share it. So as you can see, volatility is half of people are concerned with that, but evenly spread on the other three: low return, regulatory burden, and cost disclosure. So that's really good because we're going to be talking about cost disclosure in a little while. And then I'm going to show you the next poll. Will having greater clarity on costs give you more bargaining power with your asset managers? So really interesting, because it looks as if yes and maybe are kind of shared, they're about equal, and then no, 9% say no. So I guess this is definitely a trend toward yes and maybe. All right, we have one more poll for you, and that is this one. You can choose as many as you like. Which areas of governance are key priorities for you over the course of this year? So just to show you how you voted, so cost transparency and ESG reporting tied for first place, and then we go to strengthening governance, value for money, more access to data and information. So that's a very, very good segue into our next speaker, Scott Foster, who's going to talk about cost transparency. So over to you, Scott.
Yeah, thanks, Rachel, and thanks, Pat, for the introduction. I think, you know, the results of those polling questions are really interesting, and I think, thankfully, a lot of what we're covering in the next slides, you know, addresses some of those concerns around volatility, addresses some of those concerns certainly around cost transparency, and the various reporting that needs to go into it, and as well as that, how cost transparency can help schemes you know, leverage that data to increase their bargaining power with asset managers. So really interesting to see the results. Let's cover some of the topics in the slide and then open up to some Q&As later at the end of the session. So we're 1 year on since the CTI templates came out. They were released in May 2019. We've got a title here, Transparency in the is the New Normal, and I think it's very relevant today. Since a year on since the CTI templates were released and the CTI group was formed, we've got some interesting insights on how the industry has received these templates, and we actually have some highlights on a few teething issues to look out for when using the CTI templates in your cost transparency work in the coming next few months. We at CACEIS also celebrated our 3-year anniversary of providing cost transparency solutions to UK pension funds. And we've got some interesting data insights and trends to share as well. So that's great, and let's get into it. So I think this slide is really to set the scene. You know, cost transparency is the new normal is the title of the last, and I think that this slide complements you know, that headline quite well. And I think over the last few years, the desire for an increase in transparency, an increase in governance and better governance, and ultimately putting more data in the hands of the asset owners and the end consumers has been hot on the agenda, all in the name of benefiting members and end consumers. And we've seen this across the EU financial markets and in various pension industries worldwide as well. And I think there seems to be a race to get data into the hands of the asset owners and end consumers. And I think it's partially driven as a result of this sort of paradigm shift from DB to DC and the associated increasing risk, investment risk on members. I think better governance and better access to data to help determine the value of these services has been a top priority of the regulators in the past few years. And focusing on the UK and from a UK perspective, the formation of the CTI group and its templates in May 2019 has really focused the industry on cost transparency. But what CACEIS have found in using this template on behalf of some of our pension scheme clients is that we're not 100% the way there yet, and there's more on that to come. So if it's going to be your first time doing cost transparency now that the CTI templates are out, or if it's your first time using the CTI templates, I think this slide just highlights that it's good to be mindful of the fact that on average, your investment costs can come out 2 to 3 times higher than typically reported in annual reports and accounts. And this is based off independent research done in the Netherlands and with a few notable examples in the UK as well. You know, there are some examples on screen showing that in the RPMI example, investment costs ended up 3.6 times higher than originally thought. And in the West Midlands pension fund example, it came out, 7.79 times higher than originally thought. And I think on that note, it's good to be clear that these aren't new costs. It's not that the costs increased by these amounts. Those costs were always there. They were just never really reported on or reviewed in a consistent or holistic way. And the research has shown that this disparity in what's typically reported and what cost transparency reveals is largely driven by a lack of transparency on transaction costs, which were never really reported in the past. And our following slides are going to show how much transaction costs can impact the total investment cost base of a pension scheme. But as well as that, I think the disparity is also driven by a lack of good governance processes around those other costs that may not have been accounted for in a consistent manner across the industry and across various pension schemes. And I think on a positive note on all of this, working with cost transparency, certainly in our experience and in some of this research, has typically provided asset owners with a framework and a platform to overall improve standards on cost reporting, which in turn better enables cost management. And the results of that come in cost savings, as reported in the RPMI example, as reported in the West Midlands example, and also in some of our findings in the Netherlands as well. So all is not lost. So I think really critical to cost transparency in the work that's being done in the UK has certainly been standardization of cost reports and cost templates. In the past, we were working with a DCPT template, an EMT template, an ILPA template, an LGPS template, and any bespoke formats of cost data that would come in from the asset managers. And the CTI templates have been well received, and they were in a way almost necessary to rally the industry around an agreed methodology to begin to look at costs on a like-for-like basis. And from May last year, the asset management industry was given around a year to get their systems in line with the new standard. And we're now seeing that in the stats that you can see on screen. In 2019, around 10% of all our cost submissions received, so around less than 200 templates came in the CTI template. And that makes sense given that the asset managers were essentially given a year to get their systems ready. And now in 2020, we're seeing a 50% jump in the use of the CTI templates to 60% of overall submissions. So a jump of that degree in 1 year is significant, and it's showing that the take-up of the CTI templates is a success. I think that as March 2020 financial year reporting gets carried out as we speak, the results of that will give us the clearest picture on how these templates are being used and how they're being adopted a year on from the CTI release. On the right-hand side of the screen, you can see a variety of data points that the CTI template covers. Everything highlighted in bold provides pension schemes with cost information provided either by the asset manager or the fund administrator. And everything that isn't highlighted, such as account information, portfolio investment activity, performance information, and stock lending, is contextual information to help make sense of the data and the cost data that's being incurred within each investment mandate. So it's good to keep that in mind. So the CTI use and familiarity is certainly increasing. And what we've seen at CACEIS is a 20% jump in on-time submissions in the last year. And to us, that improved timeliness of submissions is an indicator of familiarity, engagement, and corresponding ease of transfer of data from asset managers to the asset owners and its various service providers. And this is certainly a step in the right direction. Despite this improvement in timeliness, we're actually finding that only 20% of the data that we receive is first time right. And of all the various legacy templates I previously mentioned on the last slide, the CTI template is the most comprehensive and detailed of all of them. And with that comes some difficulties in ensuring that all the cost data and all the contextual data to make sense of that cost data is made available. And I think the fact that only 20% of the data coming in is first time right currently indicates to us that focusing on data quality and strong vetting of submissions is still a top priority. In our work collecting cost data across all of our UK clients, we found some consistent omissions in these cost templates that are that one should be mindful of to look out for if looking to do this cost transparency work yourself and in using the CTI templates. We're finding that the implicit transaction costs can be omitted quite consistently. It's a difficult number to report and for asset managers to break out. And I would just argue, challenge your asset managers to submit this data if it has been omitted and if it is relevant, if you think it's relevant to your underlying investment. I think this will really promote behavioral change and improve overall data standards as cost data starts to come in and the use of the CTI template picks up. On the ongoing charges figure, we're finding that in pooled fund submissions, that aggregate figure is being bundled into the fund management fees paid through the NAV. And so you don't have a full disaggregation of that cost data in pooled funds. It's a bundled number that's coming in on a CTI template, which might spark some confusion when using the CTI template because there are so many fields in the ongoing charges section. But if you're using if you're invested in a pooled fund, you're only likely to get one cost number which identifies the aggregation of all of those various costs for investing in that pooled fund. It's a bit different on the segregated side, where the asset manager typically provides most of the transaction cost information and some of the contextual information around that, as well as providing some of the AMC fees as well, fees that have been invoiced. But as well as that, to cover the rest of the items in the ongoing charges section, we found that we've typically have to reach out to another party, so the fund administrator, for example, to break out some of those custody, fund admin fees, any performance measurement fees, and any other various services that are used and employed within managing that segregated mandate. And so that's one thing to be mindful of. Your asset manager for a segregated fund won't have sight of all the cost data, and you might need to reach out to various parties to make sure that that cost template is complete. And I think the last point I'm going to make here is one around the contextual information of the cost data received. You know, I think the CTI templates are designed to report on cost data, but what's really important in sort of understanding that cost data and starting to ingest that cost data into assessing value and making informed decisions based on that data is having that contextual information alongside. So, for example, turnover information, sales and purchases, flows, inflows and outflows of the fund, to compare that to your, potentially to the anti-dilution levies being employed. On the turnover side, you know, you can compare the turnover relative to the transaction cost to, you know, make sense of why transaction costs are high or super low that year. And as well as that, what we're finding is that the CTI template is, it covers a full range of various asset classes. But some asset managers tend to neglect reporting on that sort of breakdown basis, and sometimes just focus on reporting those aggregate costs and not the costs by listed equities, fixed income instruments, cash, FX, you name it. And so that's a consistent issue across asset values and transaction costs being reported by the breakdown in asset class. So, you know, that's another thing that I would encourage schemes who are looking to do this work to challenge their asset managers on in reporting, again, just to promote behavioral change and better governance in how this cost data is submitted to the asset owners. So on to the next slide. Here at CACEIS, you know, we argue for a holistic view on costs, identifying what's called the total cost of ownership of running the pension scheme. And the scheme should really know what is the total cost of ownership of running the scheme in pounds and pence, and what is that cost in basis points. I think our research has shown that the non-CTI items typically account for 17% of the total cost of ownership of running the scheme on average. That 17% typically represents fees that are already accounted for in the annual reports and accounts. However, we argue that when looking at CTI templates, when looking at investment cost data, why not look at that holistic view altogether in assessing the value for money on all the various services that you as a scheme employ. The CTI templates, as I mentioned, are specifically designed for and cater towards financial products. And yeah, don't forget to account for those pension management costs, the aggregate scheme custody fees, fund accounting fees, and aggregate scheme investment consultancy fees as well, because those won't all be accounted for in the CTI templates if you're just reaching out to your investment managers to report this information. So, in having said that on the total cost of ownership, investment costs do make up the largest proportion of the total cost of ownership. And so we're going to focus on that in the next few slides. You know, our research has found that investment costs typically make up 83% of the total cost of ownership of running a pension scheme. And so let's share some insights on some of the data that we received, so that we've done research on. So based on a sample of UK DB pension schemes with an average asset size of 7.85 billion, and this is data stretching back from 2016 to 2020, you know, we found that, and quite naturally, the AMC, the annual management charge, has come out as the highest fee, 42% category. And the next category that incurs the largest portion of the fees is transaction costs. And perhaps this may come as a big surprise. You know, 37% of the total investment costs is transaction costs, and that seems quite high. And I think in our previous webinars, if you're tuning in for the third time, you know, we've typically reported that investment costs, transaction costs make up 25% of the total investment costs of running a pension scheme, and that was using a combination of Dutch data and a combination of UK data as well. The UK universe wasn't as large. This year, and this data set focuses on the UK, and the rationale for that increase in transaction costs as a percentage can largely be explained in two parts. The first part is our client base. So our findings show that larger schemes benefit from economies of scale and typically have better bargaining power on the AMC and the ongoing charges. Hence, the transaction costs are proportionally higher if the AMC as a proportion is lower. And so that's one nuance to be aware of. Second, in the Dutch example, Dutch pension schemes have a typically more conservative risk appetite and can be more weighted to passive investments, which has typically dragged that total transaction cost reporting down in the past. As well as that, keep in mind that Dutch pension schemes have been working with cost transparency since 2015. So they've been working with this sort of cost model for quite a while. To counteract that, sorry, the slides are. So to counteract that Dutch example, UK schemes we're finding are typically more ambitious and return-seeking in their mandates, with DB schemes using quite a lot of alternative mandates, potentially hedge funds, which can incur high transaction costs with more activity in those funds. And so there's more data on that asset class nuance in the next slide. So the first point to explain the increase in transaction costs has been the difference in the client base, and I think that's an important nuance to pick up on. The second one is the methodology. And so what we're finding is that the implicit cost methodology, i.e. the slippage, which incorporates market impact in calculating implicit costs, has been a more consistently reported number in the last year. It's been around since 2018, and I think the FCA has asked DC schemes to report on this, to collect this number from their asset managers since 2018. But what we're finding is that asset managers are only really starting to report on this in a consistent way since the middle of 2019. And so that slippage typically can result in larger numbers than the bid-ask spread that was typically reported in the past. Further, as well as that, DB schemes, and that's the makeup of a lot of this data, tend to run LDI mandates, which recently started across all the LDI managers, recently started to include repo interest in their transaction cost numbers, and these can add up year over year. So getting into some of the asset class breakdowns, what we have identified is a full range of cost data across the various asset classes, and we've highlighted some of the totals and how those break down by various cost type. Looking at left to right, what we're finding is that alternatives, so private market mandates, typically incur 181 basis point average. Hedge funds 122 basis point average, with typically quite high management fees and quite high performance fees. And I don't think that will come as a surprise to anybody. That's quite well known in the market. The third most costly mandate, asset class rather, is real estate, and we found in our research that the average basis point cost of running those real estate mandates has come out at 96 basis points. And we've seen in that research quite a lot of transaction costs. So transaction costs typically make up 50% of running a real estate mandate, and that's relatively due to high turnover related to running projects, and that includes fees such as intermediation fees, estate agent, bank broker fees, acquisition costs, and of course transaction stamp duty as well. And so on all of this data, and it's important to note when looking at average costs, is that high costs aren't necessarily a bad thing. These average figures are derived across different schemes with different mandates, which have their own specific strategies and their own specific value. And so when looking at these costs, and you've got to keep in mind the context of the risk and return profile of your own asset classes and various mandates that you're invested in, to it, and you should really focus on assessing if the fees that you're looking at are in line with your expectations. And I think, you know, that's an important first step. Looking at the right-hand side of this series of bar charts, you know, focusing on equities and fixed income, we're finding that equities on average, the total cost of running an equities mandate comes at around 64 basis points. On the fixed income side, around 40 basis points. And equity costs more than fixed income, and that's largely driven by a higher average management fee. As you can see, the transaction costs are pretty much the same, 21 basis points across those two asset classes. And again, I think in looking at this data and looking at all the costs by various asset class, nuances here matter. You know, when looking at equities, for example, what is the sub-asset class? You know, EM, emerging markets, typically cost more than developed markets. They've got typically a higher AMC, potentially even higher transaction costs due to less coverage and less market efficiency. And so it's good to be mindful of that. And it's also good to be mindful that the CTI template doesn't disaggregate those asset classes by sub-asset class category. So schemes will have to do that themselves if they wanted to do a deep dive on the various specifics of their mandates and various asset classes. As well as that, looking at the fixed income side, you know, explicit transaction costs are typically embedded within the transaction price. So it's good to take a look at those implicit trading fees, which can add up in those fixed income mandates. And the question there is, you know, can you begin to assess the best execution of your managers when looking at that data and starting to take that data on in your analysis of value for money? And I think on the breakdown by asset class, as more data becomes available, you know, more insights at a scheme level, more insights on an industry level will become more pronounced, and we can begin as an industry and as individual schemes to gather more insights on what's going on within each asset class and potentially identify trends over periods of time as well. So we talked about trends, and this transitions quite nicely because here we have a full view on some overall investment cost trends from a UK perspective, but also from a Dutch perspective as well. And what we found that on a 3-year average, the UK total investment cost base has come out at 54.7 basis points. And again, this is based off DB pension schemes with an average asset size of 7.85 billion, data collected from 2016-2020. And from a Dutch perspective, we found that the total investment cost average to be 42.9 basis points of running the entire investment of each scheme. And I think looking at these two sets of data, we're finding that the range of costs is quite large in the Netherlands, with some more actively managed, so on the higher scale of fees, you know, close to 100, if not above 100 basis points for running the investment activity of those funds. The dispersion from a UK perspective is not as large. But what we're identifying is that you can have some more actively managed funds, and you can have some more passively managed funds as well. And again, these figures are averages, so, you know, take these numbers with a pinch of salt. But the wide ranges, to me, illustrate that there are schemes of all shapes and sizes, and highlights that low cost isn't the only cost path to take. You know, there's a diversity in our client base with each scheme has different objectives, each scheme has a different flight path, and the focus for each scheme when doing their cost analysis should really be on the value of the services that they employ. And that sort of value should really be viewed in context of the overall objective of the scheme, the overall strategy of the scheme. The risk tolerance, the performance objectives should weigh in here. And assessing where these cost numbers come in relative to expectations should definitely be considered. And a real focus on running your mandates as efficiently as possible is really important. And I think in the first instance, if it's your first time doing cost transparency, the first step is always quantifying, what your costs are, so then you can start to begin to assess the value of the services that you employ. And I think, all of those items are, first and important steps in beginning to assess value, and you've got to take those first steps first before making and following up on any asset allocation or asset manager selection decisions, which will naturally follow as more and more data gets revealed. So I think on this slide, the point of this webinar is a real focus on good governance. And I think here we've identified some key things to think about, and I've mentioned some already in the last slide. And I think overall more work needs to be done on value for money. And I believe the industry bodies are really working on developing a more robust and usable model for that pension schemes can pick up and use. I think we recently saw the PLSA release their DC chair statement drafting template, and initiatives like this can help educate and support schemes. And I think that's really quite welcomed. And I think, what I would say about good governance and what I would say about cost transparency in general is that if you're thinking about starting your cost transparency journey, now is a good time as ever. The CTI templates are available. Engagement on all fronts is high, and the recent market action and volatility as a result of COVID-19 has reinforced the need for good governance and effective cost management. And we are anticipating a higher turnover ratio for Q1 2020, and as a result, potentially higher transaction cost numbers. That data is coming in just now, and I think the results of those reports will begin to help rationalize, what has happened at each scheme and its investments over the last year from a cost data perspective. So, now is as good a time to start your cost transparency journey as ever. And I would really encourage schemes to begin using the CTI templates and begin, bringing that data on into their schemes so that they can begin to effectively assess value for money. And that applies across all DC schemes who have that regulatory obligation, but as well as that for DB schemes who are looking to, get ahead of the curve on this and a potential regulation that may come in the next year or two. And I think, this slide wraps it up quite well. Costs aren't bad. I think quantifying them and assessing value is key. And I hope that the slides above have been informative in giving you some first steps in achieving that. And I think that with cost transparency, the first step really in meeting this fiduciary duty on cost transparency is getting access to quality data. Once you've got access to quality data, you can begin to open dialogues between your asset managers and asset owners and begin to assess value for money and improve member outcomes. So thank you. I'm going to hand over to Pat to wrap up, and hopefully we've got some Q&A.
All right. Well, thanks, Scott. Thanks for, as you know, cost transparency is near and dear to all of us at the PLSA. We're the home of the Cost Transparency Initiative. And of course, this is the second year we've had CACEIS, formerly CASBank, as our education partner on this topic. We have a bunch of questions, so I'm going to get through as many as we can. Given the growth in the use of alternative assets in DB pension scheme portfolios, how accurately are fiduciary managers and investment consultants estimating the other expenses involved when investing in these less liquid asset classes? Nice thorny one for Scott.
Yeah, so I think from a fiduciary management and investment consultant perspective, I think I think more work needs to be done in using the CTI templates effectively. I think, you know, a lot of work was done as a result of the FCA asset management market study and the CMA sort of investigation into the fiduciary management world and that link between that and the investment consultancy space. And I think, you know, there's been language and there's been talk from the various industry bodies of using the CTI template in breaking down and unbundling those fees within those investment products. And so, you know, I personally haven't had a view on, you know, how how particular fiduciary managers have been using the CTI template, but I think, you know, overall engagement and the direction of travel in using the CTI template, which is, as I mentioned, the most detailed and comprehensive of all the templates, is going to be the natural next step.
Okay, very good. And custody question for Pat. Should pension funds press their custodians to unbundle the custody costs to show all the different services and what they cost? So safekeeping, settlement, reporting, FX, lending, voting. What do you think?
Very quick answer to that one. Thank you, Rachel, is yes, you should. I mean, your custodian should provide you with full transparency on all of the costs and charges associated with the custody service. So the answer is yes, and we certainly do that. We break down for every single service taken, so yes.
Right, very good. We've had a few questions here, all focusing, different questions, but they all are asking about reporting frequency. So can you give us market practice? What's the feedback on reporting frequency? We understand it should be quarterly, but on demand if high impact should be reported. Somebody else said, what about different timescales for submission for different asset categories? Some asset classes like infrastructure and debt may take longer. So I'm gonna ask you about all of that timescale stuff, Scott or Pat.
Is that question related to cost transparency specifically, or
Yes.
general reporting? Okay, so what we're finding is on the cost transparency perspective, frequency tends to be once a year. I think that there is scope for that to be at least quarterly, but I think, you know, the CTI templates only really came out in May last year, and so we've got to start slow, I think, in getting all of that data on an annualized basis. But I think definitely having that data available on a quarterly basis will, help pension schemes and asset owners begin to make sense of their cost data, you know, as those costs run up and down throughout the year. But I think what's important to note there is that the asset management systems need to align with that frequency of reporting. And I don't know if that's, I personally don't know if that's been considered at the moment, but I think it's definitely on the agenda.
Right. That's actually all we have time for today, but Pat and Scott have kindly agreed to answer some additional questions, and we'll make sure that they receive them, and we're going to post their answers on the site. And many thanks to Pat and Scott for that terrific presentation today. Very thought-provoking for everyone, I'm sure. And many thanks to all of you who are watching. We hope to see you again soon, and bye for now. Bye-bye.
Thank you, everybody. Bye.
Thank you.